Okay, hi everyone. This is going to be the PowerPoint lecture for Chapter 8. And in this chapter, we're going to be learning about budgeting. Okay, as I have here, a budget is a detailed plan for the future that is usually expressed in formal quantitative terms. Also, I have here it's broken down for a year period. This normally is going to align with the fiscal year and can be further broken down into quarterly and monthly budgets. So normally it's for a year. However, you can do like a quarterly budget, per month. And really, the whole point of budgets, they're going to be used for planning and controlling, right? Namely, developing goals and preparing budgets to achieve those goals, and then controlling, namely the gathering of feedback to ensure the plan to achieve the goal is being properly effectuated. In short, right, when we're talking about budgeting, we're really looking as our company at a whole in creating a budget to determine our expectations for the future, how we can plan for that, have the appropriate inventory levels on hand, make sure we're reporting the appropriate forecasts for earnings and profits. And as we go through, right, as the year passes along, we can monitor that budget and update it accordingly as we see fit. Now, with budgets, right, there's a couple different terms here, right? We have a top level budget. This is a budget where it's created only by senior management. And we have a self-imposed budget, sometimes referred to as a participative budget. And really, that's one that's created with cooperation among all the management levels. Now, normally budgets are made through some type of cooperation between upper and lower level management. They want to be challenging but achievable. So, in short, when we're dealing with budgets, sure, they can be made by kind of like the top, the top ranking guys. Normally, however, you kind of need to share feedback and understand where you're at, right? So maybe you would want to talk to a particular manager of a production plant, or because the people who really at those like medium and low levels, they're more familiar with the kind of being in the weeds, being in the trenches for how it actually works at those levels and what are realistic with regard to expectations, right? And they can also share their insight, their feedback. Probably better if everybody's at the table, right? If you kind of have just a top level budget, there may be some complaining or frustration at the lower level that, hey, you didn't include us, and hey, you aren't really familiar with what we're doing here on a day-to-day basis. So you can say that we need to achieve target X, but maybe target Y is more realistic. Okay, so the master budget, right? This is going to consist of a number of separate but independent budgets that formally lay out the company's sales, production, and the financial goals. Right, so the master budget's kind of the whole shooting match. It's a series of budgets we prepare separately, but they're connected to each other. So even though they're independent, they are connected and feed through to each other. Now, in completing the master budget, the first step that we're going to have to do here, so the very first budget you prepare, is the sales budget, right? And this basically is going to show and say, hey, what do we forecast or predict our sales to be? Based on this, right, once we start with our sales, that's the starting point, we'll use this to help prepare a production budget, which basically says, hey, if we expect our sales to be X, then we better produce Y in light of where we're currently at with our inventory. And once we determine our production needs, right, well, we need to produce Y, then we can look at our direct materials budget, our direct labor, and our manufacturing overhead budget, right? Well, we need to produce Y units. We better make sure we have this much direct materials. We better expect that the direct labor and manufacturing overhead is going to be this much. Finally, we're going to prepare a cash budget. Basically just looks at how we acquire and use cash, and then we would do a budgeted income statement and a budgeted balance sheet. Okay, so it starts with a sales budget. we'll go down to our production budget, which gives us our direct materials, our direct labor, our manufacturing overhead. That'll feed into a cash budget, which feeds into our budgeted income statement and budgeted balance sheet. We likewise will apply and create an SG&A budget and an ending inventory budget. So you can see they're like independent blocks here, right? Like each one's their own budget, but they're definitely all connected. The numbers are going to flow through. So one of the things, if you were preparing a budget in the real world, normally how this works is they usually would build out like a model in Excel where everything would ripple through. In other words, the tabs or the pages within Excel would all be linked to each other, whether it be through formulas or like direct links. But the idea is if you changed one number, it would ripple through to all the other numbers. And kind of a practice tip for accounting, just to give you a little bit of insight, always be careful if you're using Excel that you're not screwing up the formulas. In other words, there might be a template or something you're given. Before you get into accounting, the preference or the natural inclination is you want to hard code as much stuff in as possible, like put numbers in. Usually what they do in accounting is try to make it as efficient as possible, where things like link and flow, they build out models. So before you ever start actually putting information into a spreadsheet at your job, play around with the spreadsheet a little bit. Don't save it, but look and see how it connects. Look how it builds out, right? Don't just go typing stuff in and manually inputting it. It's probably, if it's like a template or a model, things are built out for efficiency and just for math purposes, right? It's better let the computer do the math, let them run the numbers. All we do is a few inputs versus hard coding everything. All right, so as we've indicated, right, the master budget contains 10 schedules, kind of like sub-budgets. And really, we're trying to answer 10 different things here. And when we ask these questions, it's based on certain estimates and assumptions. Right, so the first one here, how much sales will we earn? Right, that's like our sales budget. It's the first one. It's what we're trying to answer. The second question will be, how much cash will we collect from our customers, right? The third one here, how much raw materials will we need to purchase, right? So you could see maybe like a direct materials budget there. How much manufacturing cost, including our direct materials, our direct labor, our manufacturing overhead will we incur? So the questions here do kind of apply to different budgets. So like a production budget, that's kind of the how they're interlinked. So you could technically say these for multiple budgets. The other one here, how much cash will we pay to our suppliers and our direct laborers? What is the total cost that will be transferred from finished goods to cost of goods sold? So you can read through these, right? These are more just like theoretical. What are we getting at whenever we try to prepare each of these budgets? It's just like high level. If you're wondering like, why are we doing this? Or like, what are we trying to get out of it? We're trying to answer these questions. And this is just showing like where those questions would align with each of the budget, right? So you have your sales budget, your production budget, your direct materials budget, your direct labor budget, your manufacturing overhead budget, selling and administrative, and your cash budget. Okay, so we've talked a little bit high level about budgeting, right? The idea here is we're trying to create a budget. It helps in planning, it helps in controlling. There's different budgets we create, 10 of them within the master budget. Let's look at an example now of actually how we might create one of these. And one of the things I kind of want to, just throw this out there. This is an introductory level course, so it's really meant to just get you familiar with the idea of a budget. Actually preparing one of these, you could spend a whole course on designing. one of them. The idea with this is you will just be expected to know what are the budgets, maybe ask you some questions on like a budget, like a specific schedule, how you might calculate that or fill in a missing number. You will not be preparing a giant budget on the exam where everything links through. It's going to be more like one-shot type questions, or one budget, or just showing the relationship between two budgets. It's not feasible to have you prepare an entire budget on an exam or in a homework question. So with that, right, if we're going to look at an example here, let's just say that we're a popsicle company, right? And I'm trying to think of a popsicle company. I haven't had a popsicle in a long time, but usually they have those kind of like patriotic popsicles, right? Like the red, white, and blue ones. We'll just say we make those, and next time I go to the grocery store, I'm going to kick myself because I'm going to see the brand of popsicles. I'm going to say, oh, I wish I knew that. I want to say there's a brand of popsicles called Popsicle or something like that. It's like a play on the word popsicle. Could be totally wrong. If you go through the grocery store, check it out, and it'll give us an example here. But we're a popsicle company, right? And while having an overall profitable year, like overall we're profitable, one of the things that happened was we had a severe cash shortage in quarter one and quarter two. So the idea here is, as a popsicle company, we're kind of a seasonal company, right? Most of the time, people who are buying our popsicles, they're doing it in the warm months, right? You're not going to be out there in like the middle of December or January eating a popsicle when it's 30 degrees or 10 degrees or 20 degrees, right? This is like more of a summer product. In any event, it says here, right, we sell most of our popsicles when it's warm outside, so that makes sense, like quarter two, quarter three. And during this time, our purchasers do not pay us immediately, right? So the guys who come and then buy them to resell them, they don't pay us immediately. All right, so we're trying to avoid the cash shortage in quarter one and two again from like repeating itself. And how we're going to try to avoid that is through creating a budget. Okay, and specifically here we're going to have a sales budget, a production budget, a direct material, a direct labor, a manufacturing overhead budget, a finished goods budget, an SG&A budget, a cash budget, budgeted income statement, budgeted balance sheet, right? All 10 of them. All right, so it says the first thing we will do is look at the beginning year balance sheet, right? So right here, one of the things that we have to be aware of is last year's ending balances are this year's beginning balances. So let me think of a good way to explain this. So this is December 31st, 2020, right? So these ending balances are going to be January 1st of 2021's beginning balances. So imagine, for example, you went to a New Year's party, right? New Year's Eve party. And the idea with this is it's like 11:30, 11:45, we're getting close to midnight. Right? I come up to you. You see me at like 11:59, and you're like, oh man, Professor Donnelly, why do you have to see me on New Year's Eve? I thought our class was over. I thought I'd never have to deal with accounting again. And I say, well, unfortunately, accounting goes on, right? You just happen to see me. And I come up to you and I say, oh, by the way, how much money, I have an accounting question for you right now. How much money do you have in your pocket? You look at me and you say, oh, well, I have like $20, right? But just shut up because it's like 11:59 and, the ball is about to drop. Don't ruin my New Year's. You ruin my semester, don't ruin my New Year's. So then, the ball drops and it's New Year's. And then I come over to you at 12:01, right after the New Year's. And I say, oh, how much money do you have in your pocket? And you're just like, I just told you that, right? I have $20. Leave me alone. That's kind of, other than me being an annoying accounting professor at New Year's, the idea with that, if you can think about that, right? Last year's ending, what you had at the end of last year, right before it hit midnight, the $20, that's what you have in the beginning of the year, right? So last year's ending $20 is the amount of money you have in your pocket at the beginning of the next year, right? So one of the things here is, right, if this is the ending balance for last year, then January 1st must be, the beginning balances must be the same. Stroke of midnight, it just rolls right over. The only thing that changes here is, the date of it. It goes from December 31st to January 1st. And with this, right, imagine that our beginning balance sheet, if we were using this in Excel, is going to be the first tab in a large document, right? So in other words, you would have an Excel document that would have like all of these budgets in them. Each would have their own tab, right, that you would link over. And as I indicated, right, they would be linked to each other where the formulas would flow through, would ripple through. It's like a domino effect. You change one thing in one tab, it flows through to another. And usually there's like an input tab on there, or like one of them is the primary input tab. So just be aware of that in practice. All right, so we have our first tab in there that was last year's balance sheet. Last year's ending is this year's beginning. The next thing we're going to do is list out our budgeting assumptions. Right, so here each budget's going to have its own assumptions. We can use our estimates for what-if analysis. Instead of changing each budget's tab, we can change our estimates tab and update all the budgets at once. So what does all of this mean? Right, so if we zoom in on this, basically what would happen here is, whether it would be a statistician, people in the business, there would be some reasonable way where we would make a projection or estimates with regard to how much do we think we're going to sell, right? What do we think our costs will be, right? Maybe it's a 10% more than last year, 5% more than last year, right? Maybe you look at inflation, maybe you look at supply and demand. The idea here is you would make estimates for each budget, and for purposes of this class, they're just given to us. I'm not going to ask you to make an estimate. But in the real world, usually a statistician, people in the business, they would create these underlying estimates or ideas for the budgets, right? So first thing we're going to want to do here, right? So the very first budget we prepare is the sales budget, which in part links numbers in our estimates tab and from the beginning balance sheet, right? So part of the idea with this, for example, if we look at, let's see, beginning accounts receivable there of 90,000, we can see this flows right from the beginning balance sheet, right? And we can see here that our budgeted unit in sales, 10,000. If we go over here, right, it looks like, we're going to have a budgeted 10,000 in quarter one in sales. So basically part of this we get from our estimates, part of this we get from our balance sheet. But what we're going to take here is our budgeted, we have it built out in quarters, right? So what we expect for quarter one, quarter two, 3, 4, and then cumulatively for the year, right? So it would be our budgeted units in sales, in this case in cases, right? So cases of popsicles. So maybe 10,000 units times $20 a pop. In quarter one, we're expecting $200,000 of sales, right? Now, one of the things we said is, in part, right, we don't always collect the cash in this case immediately, right? If we go back to here, it says, during this time when we sell when it's warm outside, purchasers do not pay us immediately in cash. That must mean that it's on account, right? It's account receivable. So it looks like of these total sales down here, right? Looks like in quarter one, we'll expect to have 140,000 collected. And in quarter two, we'll have 60,000 collected. In other words, we don't collect all of it immediately. There may be kind of a delay there between when we sell it and when we collect it. Right, so in total, and you can look at this, pause it. The idea with it, what we're trying to get here is our total sales, right, for the year and our total cash collections, okay? So after we do that, right, the next budget we're going to prepare is our production budget. And it basically says, if we expect our sales to be X, right, we have this many units or amount in dollars, then we better have to produce Y, right? That's how much we're going to have to produce to meet those sales. Now, to determine production, right, we're going to use the following equation, right? So we'll have our budgeted unit sales, right, what we budgeted from the first schedule, what we expect our sales to be, plus our ending finished goods inventory, our desired units of ending finished goods inventory. That's going to give us our total needs. We're going to back out, right, our units of beginning inventory, which will give us our required production in units. Right, so again, we're doing it per quarter here, right? So like 10,000 units, 30, 40, 20. We're going to add to that our units of, our desired units of ending finished goods inventory, right? So the 6, the 8, the 4, the 3. We can see these are assumptions, right? They're assumed. It will give us our total needs. We back out our beginning finished goods inventory, right? And that's going to get us our required units, our required production in units. All right, so it says next year we're going to prepare our direct materials budget to ensure we have the raw materials to satisfy the production budget and have the appropriate levels of inventory. Okay, so basically, if we know we have to produce X amount of units, then we better make sure that we have Y amount of direct materials right on hand. So with this is a little bit of a longer setup here, but you're going to take your required production in units of finished goods. With that, you're next going to have your units of raw materials needed per unit of finished good. That's going to give you your units of raw materials needed to meet production. You're going to add to that desired units of ending raw materials inventory, which is going to give you your total units of raw materials needed. Back out any units of beginning raw materials inventory, which is going to give you your units of raw materials to be purchased. The unit cost of your raw materials, in that case, in there, and that will give you your cost of materials to be purchased. So let's kind of look at this. I think this is a little bit bigger here. You could trace it down to see the math for how it's being done, where like you multiply whereas you add or subtract. The ending goal with this, right, we're trying to figure out if we have X amount of production, right, then we need to make sure that we have a certain amount of raw materials for that. We're trying to figure out the cost, like how many of those raw materials to be purchased, like in pounds, and what the cost of that would be, right? Next thing we would do is prepare a direct labor budget. Basically, again, a lot of this links back to the production budget. If we plan on producing 100 cases of popsicles, then we're going to need people there working, helping make them, right? So basically, this idea here is they're helping us determine our staffing needs. If we have budgeted, for example, a major spike in sales in the next year, and we do our budget, well, then we better budget into that that we hire some more employees. The harder part, right, is whenever you budget your sales are going to drop and you have to get rid of employees. That's kind of obviously the not desirable position. But the idea with this is, right, we would go to our production budget, and each quarter it would show how many production, what we need to produce, and we would assign to that, how long we think or what our direct labor hours per case would be, right? So roughly, 40% of an hour. That means our total direct labor hours needed are, 5,600, 12, you multiply it down. And then say we pay our employees here $15 an hour. We're looking at 84, 192, 216, 114. After we do the direct labor budget, we're going to do our manufacturing overhead budget for our remaining manufacturing overhead costs. Right, so in this way, right, we're going to have our budgeted direct labor hours from the schedule we just prepared. We're going to have our variable manufacturing overhead rate, so maybe it's $4 per labor hour. That's going to get us our variable manufacturing overhead. Right, we'll add to that our fixed manufacturing overhead, so we get our total manufacturing overhead, the combination of both. Back out any associated depreciation for manufacturing overhead. Back out any associated depreciation. That will give us our cash disbursements for manufacturing overhead. So down here, they're showing us our predetermined overhead rate, right? So you take your total manufacturing overhead divided by your budgeted direct labor hours. That'll get you your $10 predetermined overhead rate as we go there. All right, so now that we have our manufacturing overhead costs, we can determine our unit product cost and determine our ending finished good inventory budget. Right, so with this, all we really do here is we take our direct materials that we created that budget for, we take our direct labors, our manufacturing overhead, we add them together, we get a unit product cost. Right, if we have our ending finished goods inventory from Schedule 2, and we have our unit product costs from up here, it looks like our ending finished goods, right, it'll give us a dollar amount for that. The next thing we would prepare is our selling, general, and administrative budget. Right, so really what you're going to take here is your sales, right, your budgeted unit sales. You're going to back out your per case or per unit variable selling and administrative expense. You're going to multiply times that, which will give you your, because it's variable, it's based on the sales. It varies, each sale goes up. So here it's a direct relationship, 18,000, right? That'll give you your variable SG&A expense. You then would back out your fixed SG&A and expense, and that will get you your total fixed selling and administrative expenses in that case. And then what you would do is go down, back out, in this case, your depreciation. That's going to show you your cash disbursements needed for SG&A. So depreciation is like a non-cash item. You wouldn't include that. So if we're looking at just what our cash expenses would be for SG&A, we're looking at 107. All right, after that, right, we would prepare a cash budget. And as I have here, this is divided into 4 sections and shows how our cash inflows and outflows. It's going to, examine those. And excesses in cash, which we can invest, or deficiencies in cash, which may require us to borrow, are calculated as follows. Right, so what you do here is you take your beginning cash balance, you add your expected cash receipts, that's going to give you your total cash available, you back out any cash disbursements that you think you're going to pay, and that's either going to show you how much excess cash you have, or deficiency you have, what you're going to have to borrow, right? Are you going to basically have more inflows than outflows here in cash? You'll be at an excess position. Or alternatively, are you going to have more outflows than inflows? You're going to be in a deficiency position. Right, so the idea here is, again, this is all building off of each other. So you're going to have your beginning cash balance. You're going to add your receipts, right, that you expect each period. You're going to back out any disbursements you have. That's going to show you your excess or your deficiency in cash. Then in there, right, we're going to look a little bit at our financing and help us compare here, right? We'll at the end of the day be able to look at our ending cash balance. Basically, the last part we would do here is we would complete some budgeted financial statements. Specifically, we would complete a budgeted income statement and a budgeted balance sheet. So basically, we use all of the prior schedules, right? Here for the income statement, it would be 1, 6, 7, and 8, where we would take our sales minus our cost of goods sold, gets us our gross margin. Looks like we back out our SG&A here, which is going to get us our net operating income. Below that, we'll back out our interest expense, which will get us to our net income. And then here from the budgeted balance sheet, right, we could, kind of pluck out our cash, our accounts receivable, right? So this is at the end of the year, end of 2021, what we would expect these to be. So you'd have your assets equal your liabilities plus your stockholders' equity, right? So your total assets, 722, would equal your total liabilities and your stockholders' equity, 722. Okay, so this is meant to just be a high-level introduction to budgeting, right? What we're going to work on in the problems, what we're going to see, in optional videos is maybe like a little bit more of a deep dive or examining one of these budgets, particular, the relationship between them. But the idea with all of this is we're going to start with the sales budget. Then we do our production and SG&A budget based on sales. Then we produce our manufacturing budgets, namely our direct materials, our direct labor, and our manufacturing overhead based on our production needs. All of these feed into the cash budget, the budgeted income statement, and the budgeted balance sheet. And at an overall level, while the budgets build off each other and they appear independent, they're really connected, right? So don't get lost in the forest for the trees here. They all connect and relate to each other. They're separate, but they're connected. So with that, right, I'm going to end the PowerPoint video here. We'll get into some problems. We'll have some other optional videos as well.